Everybody, I'm back. Hold on for a second. We'll get some screens up here. Apologize for the technical problems tonight. Just part of the landscape. And what we'll kind of look at is how to use the different indicators to get a much more accurate reading as far as what could be going on in a trend. And let me see if I can do this correctly. As you may have seen in the morning comments, or the members' morning's comments, we've been kind of advocating here for the last couple of weeks to have both long and short positions in the portfolio, mainly because the market's really not giving us any high probability trend direction. Let's see if I can do this. There we go. All right. Okay, we're going to have Greg come back on as fast as possible. It might not be a Thursday night. We might be doing it on a Tuesday or Wednesday night within the next, hopefully within the next 10 days. So I apologize for that. Greg's got some very good information on how to still make money utilizing your retirement accounts and or your IRA accounts. I guess which are one and the same. And surprisingly enough, he didn't have anything to sell. This was just kind of an information session. I won't be upset. Okay. So anyways, let's take a quick gander here at why or what to use as far as analyzing a trend. Yesterday, we saw a big up day in the Dow, which created a Morningstar signal, which confirmed with the close above the T line. The only thing that didn't confirm was that the stochastics were still heading down. We weren't in an oversold condition. So that left us a little bit suspicious. That's why in the morning comments, or in the comments, I was saying we had to see it trade positive because we had 2 out of the 3 factors, which is the signal itself, a close above the T line, but stochastics still needed to confirm one way or the other, which meant if they had traded a positive today, the stochastics probably would have started curling back up. But the fact that there was no real change of direction yesterday kind of still gave the implication that this might only have been a bounce instead of a move to the upside. And the same scenario was over here on the NASDAQ, where this wasn't really a signal in here, but it was a gap up. But the fact that there wasn't a real signal, and this was not a bullish Harami because it closed above the previous day's open, and it wasn't a bullish engulfing signal because it didn't open. This was just an up day, but there was some confirmation that with them closing above the T line, if they had traded a positive, they were probably at least going to come back up to the top of this channel. But when they opened it lower today and started taking it down, it wasn't that they weren't confirming. It looked like they were consolidating, but there was still the doubt that stochastics, especially over in the Dow and the S&P, hadn't turned around just yet. Oh, don't worry, Miss Peggy. I can't even get the cat to listen to me. So you can only see part of the chart. Let's see. No, that's probably more on your end. You might just have to see the little box up on the very top line that has the arrows pointing in. You might have to hit that. Okay, so that still told us that there was, now, we have the 12 major signals, and those are the ones that are going to give you probably 99.9, they're going to give you 100% of all your trades. But here's one that is a continuation pattern. This is what we call three methods falling. Notice when they had a big down day, they took it up, and after 3 days, they still couldn't get it above this level. They opened it lower and took it back down and closed below this level. That's a continuation pattern. That tells you there's still some more downside. So here's a perfect example that if you had gone short on any one of these signals, you stay short until you see a candlestick buy signal and a close above the T-line. There was a few times where it looked like it was opportune time to cover your short positions, but they could never get it back to close it back up above the T-line. So that's a very important factor. We recommended shorting Juniper because it had more compelling reason. They had a bearish engulfing signal at the 50. They came back up, did another bearish engulfing signal at the 50, and then gapped down below the T-line. Today they opened it at the T-line and went this direction. This kind of broke this little support level, which means our next likely target is down here at the 200-day moving average. These are slow stochastics. My stochastics are 12.33. So essentially there's just very few indicators that you need. First of all, the most important indicator is the signal themselves. Can you zoom out so you can see more of the chart? I mean, like that? Yeah, the T-line is the 8 exponential moving average. Very simple technique that if you see a candlestick sell signal and a close below the T-line, the probabilities are pretty strong that you're going to stay in a downtrend until you see a candlestick buy signal and a close back up above the T-line. We've been short BBRY recently because with that big break, notice what they did on the reversal day. They actually took it up, hit the 50, and then closed down as a left-right combo. That told you there was still going to be more downside. Wasn't very compelling downside, but as we can see, they could never get it back above the T-line. That tells us they're going down for a further target. And I don't know what that further target is just now, but it could possibly be back to the lows. Let's see, what else can I show that would... over in the commodity side, let's take a look at some of the commodities real quick. Crude oil is still in this kind of big J-hook pattern to the upside. The dollar is still in a downtrend. Notice it's failed at the 50. So if the dollar is heading down, that means your euro should be heading up. So this is probably still a good buy because your stochastics aren't in the overbought condition. More than likely, this price move is going to come back up to this level. Hold on for 1 second, please. I want to get out. Okay. So anyways, this one you can still buy as far as a trade because it's going to come back up and test the highs. And I don't have very much more. Let's see. RGR. I'm just picking out ones that I know are probably good short situations. As you can see, we're in a downtrend. Came back up to the 200 and then sold off. This one can probably be shorted at least for this target right here and possibly this target down here. Take breaking it down into the low 50s area. So again, this is basically just using the signals and the patterns to tell you what there is as a high probability. Can you just discuss support levels for marks? Well, for marks, let's see. Oh, for markets. Let's see. I don't know what the support levels are. Right now, if they don't hold the 50 tomorrow, and we pretty much have to see that they open this, they need to open this positive and trade positive, or do another indecisive trading day like a doji day to stay in this trend channel. If they break this down, they're going down to the 200-day moving average. The NASDAQ, if they break this down tomorrow, they're going down to the 200-day moving average. There was a gap to fill, which they came back and they filled it right here. Now we have to see if this dumpling top isn't going to start a good, strong downtrend. This is why I've been in the afternoon comments today that went out on YouTube. I was saying that a lot of people get very anxious when the market starts selling off because they're hoping for it to bottom and turn back up. But if you're long and short, or if you're buying the short funds, you don't have that anxiety. So even though the market was going down today, I was down a little bit, but I was down like a few $100 on the account, which was nothing, because I was a little bit heavier long than short, but my shorts pretty much offset any losses in the longs. So that doesn't bother me. If I can stay break even when the market's heading down, at some point I'm going to cover my short positions, take those profits, and then be set up to go long with those funds. So it used to be that I would sit there and I would hope the market would turn around so I could make some more money on the plus side. But as you can see, it's just as easy to see when the sell signals are coming in to the S&P 500. There's a left-right combo. There's a bullet bearish engulfing. There's gaps to fill down here on the S&P 500, which would kind of correlate with hitting the 200-day moving average. I don't think I had anything on the plus side. Let's see. We were looking at this one. I think it was RIG was another one. RIG had this big. Can everybody see this all right? RIG had this big bearish engulfing signal right at the 50-day moving average. And also, right at this kind of little trend channel, or a trend resistance level. So if this opens lower and does a doji sandwich, we know that more than likely it's going to come down to the bottom of the trend channel, which means it brings you down into this area. So whether you're shorting the stock or buying the puts, at least you know you have a high probability. And this is the reason why you want to have everything in alignment. And everything in alignment in this case isn't all that many things to look at. First you have your sell signal, then you have your close below the T-line, and you have your stochastics heading down, and you can see what your trend is doing. The probabilities are pretty strong they could bring it down to this level. So remember, the signals are based upon high probability results of what candlestick signals have been doing over the years, or not years, the past 4 centuries. Can you discuss commodity trade potential in this market environment? Commodities and the market doesn't have anything to do. Now, let's see. Let me see what gold did today. Gold was picking up some steam, and silver was up but sold off. So some of our, even our SSRI, which we recommended because of it bouncing off the 50 and gapping up above the T-line, backed off, but one very simple rule: you stay long as it stays above the T line. Well, somebody was asking about the why I was in coffee or what got me into coffee. Somebody else was asking why didn't we do a session on commodities, because as you can look at this chart doesn't look any different than any other chart. This just happens to be a commodity chart. I was buying coffee down here because I could see the double bottom. They gapped it up and brought it up above the T line, so I was buying right in here. And so on two contracts, it's picked up maybe $12,000 over the last 4 or 5 days. So what's the biggest pattern, or what is the big pattern we're seeing here? First of all, we've got kind of that double bottom. Secondly, we've got the J-hook pattern. Third, I know from here that potentially they could, what's that little green thing? Dang, Jiminy Christmas, get out of there. But they could bring it back up to at least this level. So if I'm buying right here, what's my risk-reward factor? That if they closed it back below the T-line, I was right back out of the trade. If the trade stayed above the T-line, I was going to have a trade that would at least bring me back up here, which would be about a $15,000 profit. And if they broke through this level, this trend could keep right on going, and I'll stay long as it doesn't close back below the T-line. Now, I'm also short cotton, because as you can see, cotton was rolling over, and where was the big decisive trading day? When they took it way up, and then they came back down and closed it down here, kind of a bearish harami with a booster behind it, and the dumpling top. So right now, this looks like it could be breaking down to where it's going to come back down to this level, and or all the way back down to the 200-day moving average. Let's see. Let's see. So this is the advantage. I'm bringing up some that people were showing in the chat room. This is the nice thing about having a chat room where everybody's kind of looking for the same signals and patterns. If somebody pointed out Jack's Pacific today, which is doing this kind of fry pan bottom. This one will probably be a buyer. As you can see, this was up strong today, even though the market was down huge. Booster means, yes, that long shadow. What was I can't even remember what I was just looking at. Well, that ain't a fine howdy do. The rig? No. Stocks have some event influence, such as earnings, reports, or commodities are affected by something. Not as much, because commodities don't have as many things to affect them, other than the weather, and that's about it. It's a pure supply and thank you. Cotton had that big tail up to the upside, kind of a booster move. So commodities have less things to influence, whereas the markets have a lot more outside influence, and individual stocks have additional more influences. The market itself, as well as individual things going on with that particular stock as well as the markets. Yeah, so you've got crop reports, but and these strategies work on commodity or on Forex. I mean, we're not analyzing any particular market with candlesticks, because candlesticks is merely the analysis of what goes on with investor sentiment. So anytime you have investor sentiment, no matter what you're trading, they're going to work exactly the same. So Forex, obviously, you don't have the gaps like you do in stocks. Stocks, we have gaps like this, which make for a very strong price trend. Whereas in Forex, and I never figure out how to bring Forex on these charts. Forex, because it's a constant trader, you don't have the gaps in between. But the other patterns work just as well. You could only on a weekend, or you do an hourly chart from 1 hour to the next hour. Maybe the sell-off today is just a trap. Well, it doesn't matter whether it's a trap or not. investor sentiment says they're selling off. We had a sell signal up here. They tried to bring it back up. Now they're back here. So this is why the Japanese rice traders say, let the market tell you what the market is doing. Right now, the market is telling us it's caught kind of in a sideways trend. So it would be important to see what they do tomorrow on an open. If they support here at the 50, that means we're still in this trend that we might bounce up eventually. But there's really no trend here. And this is why at points like this, with stochastics in the oversold area, and you start seeing buy signals, then a close above the T-line, you can be predominantly long. Situations like this, where you have a breakdown below the T-line, you can be predominantly short. Markets like this, it's wise to be long and short. Because the nice thing about the simplicity of candlestick scanning is that you can find, out of 7,800 trading entities, you're going to find some stocks with some very simple scans that are moving up during a sideways market, and you're going to find others that are moving down. So what will the QQQ do? Well, it's the same thing as the NASDAQ. It's probably coming back down to the 200-day moving average. Phil, very simple screens, whether you're using Metastock. Right now, they've just put up my scanning technique or scanning package for finding the best signals and patterns, which we've quantified. A lot of people ask which are the best signals, which ones are better than the others. Well, the 12 major signals are pretty much what you're going to see most of the time. But there are some that work consistently well, like a doji gap up, your best friend, is going to cause a very strong uptrend. Then your left-right combo, which is a doji followed by a bearish engulfing signal or bullish engulfing signal, is a very strong trend. A breakout from a fry pan bottom is also a very strong signal. So even if the market's moving in one particular direction or the other, or sideways, you're always going to find very good trades. And that's, again, another nice thing about the chat room is if you want scans for Thinkorswim or TCNet or any of those, somebody out there has the formulas for the scans. We've got the formulas for scanning on TC2000 on the website. All you have to do is plug them in. Okay. Sorry I don't have more info tonight. I was completely unprepared, thinking that, let's take a look at a few of them, like Apple real quick. Apple is also a situation where you let the market tell you what the market is doing. And right now, Apple is telling us it's moving sideways. So I wouldn't be trading Apple until it breaks out of this wedge, because you're going to get whipsawed. Let's see. We'll take a look at a couple of the biggies anyways, and then we'll call it a night. And I apologize for the technical problems, but that's the Internet. IBM did the shooting star bearish harami, which is very simple. If they open this lower tomorrow, close it out. You can always wait to see what it does once it gets back to the T-line. Google is showing you that you stay short until you see a candlestick buy signal and a close above the T-line. Now, we had that bullish engulfing signal and a close above the T-line. So today, if you were buying Google, you needed to see it open positive and start trading positive. Well, it opened flat and immediately sold off. This tells me they're still taking it down, heading for the next support level. Netflix. This did a left-right combo. This will be very important to see how they open this tomorrow. If they open it lower, that means they're still taking this down, and the 200-day moving average is not acting as support. And it's got kind of that bearish or three methods falling. Again, if they open this lower, your next target is at least to this level, possibly even further. Netflix, Amazon. stay short. And notice once again, when you had the sell signals up here, you had your doji, hanging man, bearish engulfing signal, and a close back below the T-line with a doji sandwich type situation. All you can do is stay short until you see a buy signal and a close above the T-line. And the T-line is very effective. I used to make decent money trading candlesticks without anything, or without the T-line. Once we were introduced to the T-line, my income has skyrocketed dramatically from there. Yahoo, stay short till you see a buy signal. And Tesla sold off hard today again, and it's in the same situation. Right now, you want to stay short. If it opens lower tomorrow, breaking this level, they're going down to the 200-day moving average. It looks so easy on a chart after the fact to call out the candlestick patterns, isn't it? That's why you want to, as you'll find, a lot of my teaching is very repetitious, because all we're looking at is what occurs in investor sentiment day after day, week after week, decade after decade, century after century. This one, if you were long, you should have been out of it with the bearish engulfing signal and close back below the T-line. Again, right now, if they open this lower, the next target is down here. So I went through the same process, and unfortunately, when I was going through it, there was nobody around to kind of advise me what to do. So I had to learn. So finally, when I learned that I anticipate what type of patterns we should be looking at, knowing what should happen next. If that's my Morningstar type signal, they should close this above the T-line. So it allows me to move a lot faster to say, all right, if I'm buying here, or even if I was buying here, a doji in the oversold condition, and they start trading it up, I want to be a buyer, because I know exactly what should happen. This should be a bottoming action. Notice how far away we are from the T-line. Notice our buy signals. That allows me to buy immediately. What's my risk-reward factor? The probabilities are that we should be heading up from here. My risk factor is, if it heads up and then starts trading back down below this level, I want to be right back out of any trade or whatever I'm trading, because it was a doji in the oversold area with bullish confirmation. It shouldn't come back down below the doji. So there's once you know the signals and recognize them, then you also will understand very simply what the rules are, what the expectations are from that symbol. Can you talk about stops? Yes, stops are just as easy. A lot of people will say, well, my advisor says I should stop out at 3% loss, 6%, 8%. I keep telling people the market doesn't give a hoot where you bought. The reason you're buying usually using candlesticks is because you're seeing where there's been a decision to buy, and then you close out when you see the decision to sell. So if you were buying here or thinking about buying, and this was your buy signal and you got in, you close it out if it closes more than halfway down this candle, because the Japanese rice traders had a very simple philosophy. If this was the signal that told you that the bulls were taking control, if they closed it more than halfway down this candle, the bears were still in control. You close out the trade. All right, I can't think of any more rhetoric to give you all. Again, apologize. We'll have Greg back on. He's got some very good information, especially for those that need to have some more opportunities in their retirement funds. So, anyways, we'll be back in the chat rooms tomorrow, and folks in the option trading room, I'll have a couple ideas for some credit spreads for tomorrow. All right, we'll see everybody in the chat rooms. We'll have Greg back on sometime, probably not this coming week, but right after next week. Do you day trade in chat? Yeah, we got day traders in there. We've got scalpers. We've got swing traders, and we've got long-term investors. You just kind of pick out the people that you see are trading in the same manner you are. All right. Thank you, everybody.